Okay, good afternoon and welcome back everyone to our Thursday afternoon options education session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and today we're here to talk about a strategy that is the most widely traded strategy of all options investors. Maybe you've traded it before, maybe you haven't, but today we're just going to take a deeper dive into trading covered calls. It's a strategy that I think pretty much every investor should be familiar with and should be utilizing as much as possible in your portfolio. And even for absolute beginners, it's a great way, in my opinion, to get a sense for how the value of an option fluctuates through the life cycle of an option and be on the right side of that. Because when you're buying calls and puts, the time premium decay is working against you. When you're selling calls and puts, that time premium is working in your favor. But cover calls is the only strategy that allows you to sell option premium, naked options, effectively selling just having a naked call option that you're short that doesn't have any additional risk. Because if you actually short a naked call option that's not covered, you have unlimited risk. But with a covered call, you have limited risk, so it's technically a riskless strategy. So it's really suitable for just about anyone, no matter what your risk tolerance is. As long as you own some shares, selling covered calls is a great way for you to get acquainted with options trading and learn more about how just the value of a call or a put changes with respect to the stock moving higher or lower or time moving by. So let's go ahead and get started and take a look at this. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today what we're going to cover is basically what is a cover call to start off with. This is for those of you that are brand new to the strategy. We'll give you a cover call example just to show you what that strategy looks like. We'll then take a look at what are the optimal credit calls. This is where we're going to spend a bit of time here today, because a lot of investors have been talking about a lot of investors are asking about what are the right strategies in terms of cover calls, what strike prices to choose. So I want to go through a few examples so that you understand the best practices for selecting the optimal covered calls, because the optimal covered call is actually the most counterintuitive. It's not the one that you would think that you would want to choose. So I want to make sure we walk through that, understand exactly why those are the optimal cover call settings, and then we'll show you the cover call reports that we generate on a daily basis to help you implement the things that you're going to learn here today. Because what I understand that a lot of investors are interested in learning about cover calls, but when it comes down to implementing it in your portfolios, we want to make sure that you have access to the reports, you have access to the tools that make that as easy as possible for you. So I want to share with you the reports that allow you to do that. Then we'll talk a little bit about management of these trades. So once you're in a cover call and you have the stock has moved higher, it has stock move lower, what do you do with the different scenarios, making sure you understand the best practices. We'll go through as many live examples as possible before we open this up for Q&A here at the very end. So the primary question that I want to help investors answer on this particular session today is, how can I generate additional yield on a portfolio using covered calls? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you 15 years of market strategy research and why we still consider using covered calls in pretty much all portfolios, no matter whether you're aggressive, conservative, why cover calls really suit all possible scenarios, and share with you the years and years of back testing we have done with this particular strategy to arrive at the optimal settings when it comes to a cover call. So before we get started, I just want to do a quick poll here. Could everyone please bring up your chat window, which is at the bottom of your screen? And please type 1 into the chat window if you've traded a cover call before. And please type 2 if you've never sold a cover call before. Okay, I see a lot of 1s. I see quite a few 2s. And I'm curious, for those of you that answered 2, meaning you've never sold a cover call, if you don't mind, just write 1 word or 2 words as to why you have not sold a cover call. Is it just you've never learned about it? It's not exciting enough. You don't have enough capital to own 100 shares. I'm curious as to some of the questions. Don't know what it is. Still in the learning process. I don't have 100 shares. Low return, interesting. We'll talk about that low return part. A lot of people don't own 100 shares of that stock, and that's totally understand. Worried about how to manage. Okay, that's a good one. There's a lot of people saying that they don't have enough capital to buy 100 shares, and that is understandable. You do not understand the strategy, so today we're gonna talk about this. Mike Lee said too risky. Mike, this is the only option strategy that we consider riskless, meaning you cannot add risk selling a cover call. So I don't think that that's quite accurate. So at least we'll go over that today so that you can hopefully understand that a little bit more. Not sure how to make income, not enough knowledge. So we'll talk about all of these. I saw quite a few about hard to manage. We'll talk a little bit about the rules for how to manage here today. Dangerous because can be assigned on stocks that would generate a big capital gain. And Jock, we're going to talk about that because a big part in selecting the optimal strike price on a cover call is because of that fear. So I'm glad that many of you have said that you don't sell cover calls, and I'm glad many of you have shared with me why you're not selling cover calls. And maybe, those reasons that I just listed out echo with you. We're going to address many of them here today. So let's start off by just a brief understanding as to what is a covered call. A covered call is actually about as simple as it possibly gets. What you're doing is you're selling a call option against a stock position that you already own to generate income on an existing stock position. Now, so what you're doing is you're taking a stock position that you already have. So this means that you don't have to go out there and buy a stock. You don't have to you look at the stocks that are currently in your portfolio. And what you want to do is you want to sell a call option against it, just the regular call option against that stock position. And that is going to help you generate income. And when you sell a call option, what happens, right? When you sell a call option, you have the obligation to sell your stock, at a specific price sometime in the future. That's what a short call option obligates you to. Now, the reason that you're able to do this when you have a stock position is because you already own the stocks that you eventually have the obligation to potentially deliver on. So when you sell a call option, you have the obligation to sell the stock at a specific price sometime in the future at a higher price, generally speaking. And because you already own the stock, you know that you can satisfy the delivery of that cover call in the future. So that's why we call it a covered call and not a naked call. A naked call is when you sell a call option without the shares that you need to eventually deliver at. So when you sell a naked call, you truly have unlimited risk because if the stock keeps going higher and higher and higher, you're going to have to buy the stock at a higher price to deliver it at the set price that you've sold or obligated to sell at that specific price. Now, this strategy requires at least 100 shares of the underlying stock. The reason for that is because each cover call you sell obligates you to deliver 100 shares of stock. So in order for it to be covered, you must own at least 100 shares for each contract that you sell. That's how it becomes covered, right? Now that should be pretty simple. Does everyone understand that? Please type 3 into the chat window if that makes sense to you. Perfect. Okay. Lots of 3s. So let's just talk about a quick example here, right? Let's say I'm looking at Seagate Technologies currently trading at $90 a share. And let's say I own 100 shares of this stock, and I think the stock is going to reach $100 a share. That's my kind of target price on the particular stock. So what you can do is you can sell 100 shares of this. Your goal is to sell 100 shares of the stock at your $100 target price. Okay. So how can you do that? As a stock investor, there's an easy way to do that. You place a limit order that basically says that if the stock rises up to $100, I want to sell my stock and I want to take profit on that trade. When you place that limit order, you're obligated to sell your stock at $100 a share. Now, as an options trader, you can do a similar type trade. You can sell a June $100 call option, because when you sell a $100 call option, what are you doing? You're obligating yourself to potentially sell the stock at $100. That's what a short $100 call option does. The difference between a limit order and a covered call is that the limit order pays nothing. If the limit order sits there, if the limit order gets triggered, whether it takes a day, a month, a year, that order does not pay you anything. When you sell a covered call, on the other hand, you get paid premium for between now and the time that the option order expires. It's almost like a good till cancel order that has an expiration date on it. And between now and that date, you are guaranteed to be paid a certain amount of capital. In this particular case, because I'm selling this call option for $1, I am guaranteed a $1 premium, $1 income if I hold this call option to expiration. So let's take a look at those two outcomes. If I'm just a limit order seller on this particular trade, I'm risking $90 a share because I own this stock at $90 a share. My potential reward is $10 a share, because if the stock goes from 90 to 100, I make $10 per share. And for the time, the exposure that I have exposure to the fluctuations of XYZ until the stock reaches $100. And between now and that time, I'm exposed to the stock, and I could potentially collect the dividends of that stock. Though that's my outcome or my exposure when I'm long the stock and I have a limit order. If I instead sell a covered call, my risk is immediately reduced from $90 a share to $89 a share. And my reward is increased from $10 a share to $11 a share, because I've reduced my cost basis from $90 to $89. And during this time, while I wait for the stock to rally up to that $110 price, I can generate income each expiration. So each time this call option expires worthless, if it expires worthless, I get to collect income. I also get to collect dividends because I own the stock. And I do this until Seagate rises to $100 per share. So what you can see is that I have the same obligation as a limit order as when you sell a cover call. And most people may not make that connection, right? That you have a limit order that obligates you to sell, but a cover call obligates you to the exact same thing, but one order pays you money. In this particular case, what I'm generating is 1.1% of the stock's value, because $1 out of $90 is 1.1%. I'm generating a 1.1% yield in a single month here. Between right now, it's just the beginning of May, a month and a half rather, from May to June, month and a half, roughly 45 days, I'm generating 1.1% yield. So I saw a few investors, saying that, not enough income, low yield, and 1.1% sounds pretty minimal, right? Reducing my risk from $90 to $89 doesn't sound like a whole lot. But when you're able to reduce your risk by 1.1% each month, for every stock that you own, that adds up to be quite a bit at the end of the year. It adds up quite a bit over the period of your holding period of your entire portfolio. And that's where it comes up in terms of paying dividends for your portfolio. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. And we'll go through some real examples to show you exactly how much yield you can choose to expect, because I know when you look at these types of numbers, you'll saying, yes, I've reduced my risk by $1. I've reduced my reward by $1. That doesn't sound like a whole lot. But when you're able to do that month after month, quarter after quarter, it adds up. And many people may not realize just how much yield there is, especially when you think about the dividend yield that you collect on income on stocks that are 2%, 3% maybe, some of them as high as 5 or 6% on the higher end. But cover calls many times will generate 5, 10, even 15% yield a year. So significantly higher yield than what you're currently getting from your covered call, from your dividend yield. But we'll put that aside for 1 second. I want to talk about yield and strike prices for 1 second, because a lot of investors complained, when I asked, why do you not currently sell cover calls? Let's see, what were some of one of the great reasons that I was saying, that I was showing here before. Don't want to get called out on long-term investments. That was one big one. Someone said dangerous because can be a sign that stocks that would generate a big capital gain. Don't want to dump out 100 shares on unknown stocks. The tax consequences of being called away. These are all legitimate concerns. But from my perspective, that comes down to not the issue with cover calls. It comes down to how do you select your strike prices? Because if you select your strike prices correctly, you are going to capture large moves to the upside, and you're going to generate a fair amount of yield that is still going to be, in my opinion, very strong and worth the time that you might want to consider. So let's use Seagate Technologies as an example, currently trading at around $88.61. This stock generates a dividend yield of almost 3%, which is actually fairly strong for a technology stock, fairly strong for an S&P 500 stock. S&P 500 average yield is just about 2%. So the fact that this generates 3% yield is actually on the stronger end. So at an $88 stock, first of all, let's talk about the optimal credit spreads. So this is where we can backtest this to death, but 45 days of option selling strategies, whether you're selling credit spreads, cash secured puts, cover calls, those are your optimal expiration dates for selling covered calls. And all of these strategies, 45 days out is what we use when we're selling covered calls. Now, what I tend to find varies quite a bit from investor to investor is the strike price. So on an $88 stock, I think some investors will choose perhaps $90. Some will choose $95. Some will choose maybe $97.5, which is the all-time highs. Or maybe some of you will choose something as high as $100. Now, this is really where, the investors that have complained that cover calls tie your hands if the stock is bullish beyond the initial assessment, that if the stock rallies significantly, you lose out on upside here. That complaint, in my opinion, comes down to when you select strike prices that are too low. So I have three choices here. I have 95, 97.5, and 100. This is an $88 stock. So the $100 strike price collects 75 cents. The 97.5 strike collects $1. The $95 strikes collects $1.50. And here are the yield terms. Now, most investors don't think of this in yield terms, but for those of you that do, I tend to find a lot of OptionsPlay, a lot of cover call investors. What they do is they try to maximize the amount that they collect. They try to maximize yield. They'll say, yes, a cover call is an income generating strategy, so I want to generate the most income. That makes sense, right? Because the more income that you receive, the more premium, the more profits you generate for your portfolio. But our back test for cover calls, this is going back to 2007 to today. This is about 14 years of back tests. Clearly, night and day shows that the best optimal strategies for cover calls are actually the ones with the least yield, which doesn't make a lot of sense when you're selling cover calls, right? Because a cover call is an income generating strategy. Why would you want to choose cover calls that have lower yields? And the answer all comes down to exactly the reasons that many investors complained about cover calls, is that they lock you out of upside, meaning what you're doing is you're selling your stock at a lower price. Now, the one thing I will always say is that it's easy to say in hindsight that the stock made a big run and I could have made more money. And that's always going to be true, whether you're selling cover calls or not, because you can do that with limit orders. You can just do that in general of selling stocks that, many times you have a stock that's run from $80 to $85, $90. And you say the stock's made enough of a run. I gotta take profits only to have the stock run. You're always going to have that problem. You're never going to be able to maximize the yield or the capital gains on every single stock. That's just not possible. It's always easy to say that in hindsight, but never easy to make that decision in the moment. However, when we're selling cover calls, even though it's an income generating strategy, what you actually should not be optimizing on a cover call is where do you get the most income? what you should be optimizing is, where do I have the most upside? Meaning you should really only be selling strike prices where if the stock exceeds your strike price, you've really outdone yourself in terms of selecting that strike price, in terms of selecting that stock, meaning this stock has to make a big run in order for you to sell your stock. That's the reason that you want to sell a cover call, is not actually for income. It's to take profits if the stock makes an outsized move that is unexpected, so that if the stock makes an outsized move, you're able to take profits on that outsized move. In the meantime, while you wait for that outsized move to happen, you're going to generate a little bit of yield, not a ton, a little bit of yield. But even that little bit of yield, look at this, the $100 strike price that collects only 75 cents, which for a lot of investors on an $88 stock will say 75 cents is not enough. But at a 7.4% annualized yield, that is still more than double what you're earning from holding onto the stock. So when you think about this, by owning Seagate Technologies, selling a really far out of the money strike price, like a $100 call option, you're generating an additional 7% yield on top of the 3% that you're earning from the dividend. So all in, you're earning 10% yield just by selling cover calls. And if the stock makes a huge jump to the upside, what you do is you take profits. And a lot of investors think about that and they say, I sold that at $100, but maybe the stock can go to 120 or 130. Well, first of all, nothing stops you from buying that stock again and getting back into the trade or rolling your cover calls. So selling a cover call does not lock you in from selling the stock. It just allows you that most months when the stock doesn't make that huge move to the upside, you're able to generate some additional yield. So it comes down to how you select your strike prices. And many times what we do is we always use delta to select our strike prices. So the the $95 strike is a 30 delta, 97 is a 25 delta, the $100 strike is a 15 delta. Now, for those of you that are not sure what delta is the approximation of the probability of the stock being above that strike price. So a 15 delta means that there's only about a 15% chance Seagate Technologies will be above $100. There's a 25% chance it'll be above 97.5, and about a 30% chance that the stock will be above 95. So when you sell a 15 delta cover call, and this is why we use deltas when we select our cover calls, because we only want to select cover calls that have about a 10 to 15% chance that the stock is going to get called away. So if you consistently sell 15 delta cover calls every single time you want to sell a cover call, you will only have 15% of the calls that you sell run away, get called away. Meaning the stock has to make a sizable move in order for that to happen. And in the meantime, what you'll generally collect is roughly double what you're going to collect on the dividend itself. So you're basically tripling the dividend yield. And then if the stock generates a big move to the upside, you're able to take profit on that stock. Does that make sense to everyone? Please type 5 into the chat window if that makes sense to you. And that is the correct way to think about a cover call, not as an income generating strategy, not as a strategy that's going to rob you of your upside returns, but selecting cover calls based on that concern, based on the fact that you're concerned about your stock being called away too early. Now, why do I find that most investors generate, and just think about this, right? The $95 strike collects $1.50. The $100 strikes collects 75 cents. That is a difference of only 75 cents. But how much upside are you giving up? When you sell the $95 strike versus the $100 strike, you're giving up $5 in upside in exchange for 75 cents more in profits. This is the dilemma that you have as an options trader, is where do you find the optimal strike price to sell? And from our experience, it's much better to have that extra $5 in upside and take on 75 cents less income, because it's going to be worth it for you in the long run. So I hope that this illuminates just how much upside you're giving when you prioritize selecting cover calls based on income alone. I see this all day long. I would say most of the complaints that I see from users that say that cover calls have robbed me of my upside are the ones that prioritize income over the capital appreciation of their underlying stock. Because regardless of which option you select, the biggest risk you're taking is the stock that you own. So in order to offset the risk that you're taking on that stock, you must make sure that you are getting paid enough upside so that if the stock rallies, you're able to participate on it. Otherwise, it's not worth taking on that risk. So when the next time you're thinking about selling a cover call, do not prioritize premium. Do not prioritize annualized yields, because many times investors will say, I want to generate 14% yield versus 7% yield. And that makes sense on the surface. But think about how much you're giving up here. Here, you're giving up $5 in upside of the underlying stock when you choose that option that has an extra 75 cents in income. Okay, so that is the most important thing to remember when you're selling a cover call. So how can you actually apply this? This is really where our cover call reports come into play. We produce these reports every single day for investors, where you have a list of every single symbol in the S&P 500, as well as our very liquid ETFs list. For those of you that hold on to ETFs, we tell you exactly the expiration date, the strike price, and the current price of the option. We show you the liquidity of the option. We show you the next earnings date and whether there's earnings between now and that expiration date. And we show you both the raw and the annualized return. And this is designed to help you quickly understand how much potential yield that you may have with these cover calls, so that you can quickly determine whether there's enough yield. And, Seagate was a pretty boring one here. Let's go through the actual report right now. Here's the actual report here from today. Like I said, Seagate is kind of boring here. Let's take a look at something slightly less boring. Let's look at Alaska Airlines. Alaska Airlines currently trading at about, I don't think actually that is a valid one. Let's take a look at that. So this is a bid-ask price that is extremely wide. So I don't know that that is a valid trade here. We have seen, so this is one of the, I would say, downsides to GameStop, is that what we have seen is that a lot of out of the money call options have been priced at these really, really absurd bid-ask prices. And they've skewed quite a few things here for us in terms of being able to get accurate bid-ask quotes on some of these types of stocks. So, when you're seeing bid-ask quotes that are this wide, or the bid price where it's all 5 cents, it's becoming more and more difficult to find reasonable cover calls. But here's one, CLF. As you can see here, CLF currently trading at $20. The $25 strike price collects 50 cents, 51 cents in terms of premium. And this doesn't report earnings until July 22nd. So the expiry date of June 18th there's no earnings between now and expiration. It's very liquid, and it generates 2.55% raw yield, meaning you're going to generate a 2.5% yield over the next 43 days, which annualizes out to 23% over the year if you were generating cover calls month after month. So especially for those of you that are concerned about missing out on gains, well, the annualized return on this is 23% if the stock doesn't move just from selling cover calls. So many times it may seem like you're giving up some gains by selling cover calls, but you can actually gain a fair amount of yield even if the stock doesn't move from selling cover calls. So this is really where this report that we've created is really designed to help you better understand where you can potentially generate some income. I do tend to favor sticking with the very liquid names, because those are the ones that are less likely to have these 5-cent bid prices. So as you can see, very liquid names like Plug Power, Palantir, Peloton, CLF, Snapchat. These are all ones that you can find fair amount of premium in order to sell. And you can use this report just to go down the list from the stocks that you own, because this report is sorted based on yield. So if you look at this stock, if you look at this list, you go down the list and you find the first stock that you own. Let's say you own Zoom. Then you know that on Zoom, you can sell the June 18th 340 strike. You'll collect $6.30 on that call, and that generates a 2.18% yield or 20% annualized return. So even if the stock doesn't move you're going to generate an additional 20% return this year from selling Zoom calls versus hoping that the stock rallies 20%. And you can use OptionsPlay as well. OptionsPlay has the income panel here on the upper right-hand corner. When you click on the income panel, this allows you to type in a symbol. So let's say we're looking at Zoom, and quickly scan for the cover call and short put opportunities. You can click on the income settings button, which will allow you to select your own risk tolerance. Your own time frame, short, medium, long term, as well as conservative, optimal, or aggressive as part of your risk tolerance. And OptionsPlay will actually go out there and automatically select the expiration date and strike price based on your settings. So if, let's say, we're doing Zoom communications, this is looking at the May 28th, 342.5 covered calls. As you can see, this generates 0.53% annual raw yield, but it generates 8.78% annualized on a stock that pays 0 dividends. And especially when you're dealing with stocks that are not paying any dividends, cover calls is a great way to generate some additional yield on that portfolio. So this allows you to quickly click on modify if you want to change the expiration dates to, let's say, the June expiration date. And we were looking at Zoom, and this was the June 340 calls. So if you own Zoom, you can go to the 340 calls. And as you can see, that'll generate roughly 2.5% raw yield. So just by selling the June 340 calls, that'll give you a 2.5% reduction in your cost basis, which is a 21% annualized yield over the full year. And this is a $340 cover call on a $293 stock. The stock has to rally about $50 between now and June. So basically it would have to get back to its recent highs here around 340 just for this strategy for you to potentially get out of this trade. And, from my perspective, if this stock got back to the top of this trading range, look at this stock. This stock is already breaking down, right? If it managed to get all the way back up here, even as a non-cover call seller, I would probably want to take some profits by then, because this is a stock that's already turning lower here. I want the opportunity that if there is a bounce, that I do take advantage of that and take profits. And that's where cover calls allow me to automatically do that while collecting a 21% yield, waiting for those types of rallies to happen. Now, Zoom may not be the best scenario because maybe this is not a stock that you want to hold on to, but very well it could be a stock that you are holding on to and you're waiting for a bounce. And this is really where you want to use the OptionsPlay tool and our cover call reports that allow you to scan for these opportunities. So maybe Zoom is not a stock that you own. Maybe, let's see, what's the next liquid one that I think a lot of investors may have. Maybe Airbnb. Airbnb is a good one because I think this is the type of stock that a lot of investors are thinking long term. I think this is a stock that can do very well. So let's look at Airbnb. This is telling me to sell the June 18th 185 calls. Let's look at Airbnb. This is currently trading at 153. I want to sell the June what was it? The 185s. So that generates 2.2% of raw yield, which is an 18% annualized yield. So just by selling cover calls, I can generate what is the equivalent, if you will, of the stock rallying 18%, even if the stock just sits, doesn't move, or if the stock declines by 18% over the full year, I effectively have a 0 loss on that trade. That adds up in the long run. So especially for investors concerned about giving away upside, think about how much upside you gain from selling cover calls as well. And again, this stock pays 0 dividends. This pays 18% yield. And this stock would have to rally up to 185 by June expiration, which again was the recent high here, right? So if it managed to get all the way back up here, I think that's, number one, a great potential opportunity to take some profits or get out of the trade that you were in. And this cover call allows me to do that. And if it doesn't happen this next month, then I keep the $340. I get to do it again after the June expiration, maybe collect another $350. And like I said, when you choose these types of deltas, these 15 deltas, and that's exactly what this 185 is, right? 185 is 21 deltas, 20 deltas. Then 4 out of 5 cover calls that I sell will expire worthless. We've backtested this over tens of thousands of trades to see how accurate is delta in showing us the number of cover calls that are actually called away. And when we sold the 20 deltas, roughly 20% of our stocks got called away. 80% of them expired worthless. And this is why, if you want to generate consistency in your cover calls, you must use delta. Don't use I want to collect 2%, or if I want to sell cover calls that are 10% out of the money. If you do that, you're not going to see consistent results. But if you use delta, you will know exactly what percentage of your cover calls will get called away. And if you sell that 15 delta, guess what? The stock is going to take a big move to the upside in order for you to get called away. And even this 15 delta is still 11% yield. On a stock that pays you 0 dividends, you can generate 11% yield. And if the stock makes a big move to the upside to 195, you get to take profits. That's not a bad outcome, in my opinion, for you to take profits when the stock makes huge runs to the upside and you're able to take advantage of it and roll those profits into the next trade. So next week, we're going to talk about selling puts, because once you've actually sold these stocks at a profit, you want to take that and start thinking about selling a put option on the next stock that you want to own. So we're going to take that, and we're going to take what we learned here this week and roll it forward next week to, okay, now that you've sold this stock at a profit, what do you do with that? How do you buy your next stock? How do you buy your next stock? You're at a lower price, because think about it. You want to sell high, buy low. Cover calls allow you to sell high. That's the whole point of cover calls. Pick a strike price that's really high. If the stock reaches there, 8 out of 10 times it's not going to reach there, but 2 out of 10 times when it does, get out, take those profits, move on to the next stock. That is what some people refer to as the wheel strategy, because you go round and round and round. You want to take profits, roll it back in the next trade, buy cheaper stocks, and do it again. Do it over and over again. This is the second part of the wheel strategy, taking profits. Because at the end of the day, the stocks that you own, why do you own them? Because you think they're going to go higher. You want them to go higher. And if they do, you want to take profits. Take profits off the table. Cover calls allow you to do that. So let's talk a little bit about, there were a lot of complaints also in the beginning about the management of cover calls. People saying that it was too difficult to manage cover calls. If you're in that position, please type 6 into the chat window if you find cover calls sometimes difficult to manage. And I would say 99% of the time when people say cover calls are too difficult to manage, it's because the stock rallied significantly, right? If you agree, please type 7 that you think it's too difficult to manage because you're concerned, you think that the stock has rallied too much, right? So here's the thing. I cannot stress this enough. If your stock, first of all, if you select your strike prices correctly, meaning the way that we just showed you, and when I say correctly, I don't mean that we're better than you. I mean that we have backtested this strategy over the past 14 years, and there is no way to not lose out on upside unless you choose these really high, really far out of the money credit cover calls. If you choose a 25 delta cover call, or if you choose a 30 delta cover call, I guarantee you will make less money on those portfolios than if you didn't sell cover calls at all. And that was most of the complaints that we saw from investors, was that selling cover calls, you gave up on too many gains. But when you sell the 15 delta and you sell the 10 delta, you actually make more money from selling cover calls than you would if you didn't sell cover calls. And that's our criteria. So when I say correct or incorrect, that's what I mean, because incorrect cover calls, meaning you're actually going to make less money than if you didn't sell a cover call, because you want to generate more yield, right? You want to generate more income for your portfolio. The only time that happens is if you select cover calls that are about 10 to 15 deltas maximum. If you choose 20 deltas, 30 deltas, 40 deltas, you are guaranteed that you're going to lose out on gains of the underlying stock, because again, that extra 50 cents or 75 cents you're collecting is not going to offset the $5 you've lost in the potential outcome of that stock portfolio. So when I refer to doing things correctly, you should be happy that the stock is called away, because that means that you were able to make a really nice profit on that particular stock in a very short amount of time if you select your strike prices properly. But if you're in the position where the stock rallies significantly, and usually this is based on some kind of new information, right? So when I sell the Seagate Technology stocks at $100 strike price, at that time, I believe that the stock, $100 is a pretty big move to the upside. I'd be really happy if the stock rallied up to $100 and I was able to take profit on this trade. But if, let's say, as I got closer to an expiration, the stock is at 100, maybe even 102, 103, 105, and there's new information that has come out. Maybe one of their competitors have gone bankrupt. Maybe, I don't know, maybe they had earnings and the outlook was substantially better than I had expected. New information has come out, and now I believe that $100 is maybe cheap for the stock, and I think the stock can now go to maybe 120, right? So you have to first ask yourself, if the stock rallies significantly between now and expiration, is it just because I was right and I'm now able to take profits on it? Or does new information exist and now I think the stock can maybe reach 120 or something higher? Because in most positions, things have not materially changed between now and 1 month from now. So from my perspective, if a cover call reaches my cover call price, I'm happy to take profits and simply take that money, take my profits, and move on to the next trade. And remember, you're never, ever going to be able to extract the maximum capital return on any stock. That's just not going to happen. Only in hindsight are you able to do that and say, oh, if I only had sold that stock at the top, I would have made X amount of money. But you will never, ever be able to do that. So don't even try. Don't rack your brain over trying to do that. But if new information does come out, it's very simple as far as the rules is what you can do if the stock rallies above your strike price. Number one, do not panic when the stock rallies above your strike price. You want to hold on to that position. You only want to roll that position from the $100 strike price to the 120 strike price. You only want to do that roll 2 weeks from expiration. If you do it too early, you lose out on the time decay that you are going to be paid by just holding on to that cover call. So when you have a cover call that has rallied significantly, make sure that you don't panic. Hold on to that cover call. And if you need to roll the cover call because things have changed, new information has come out, and you think the stock can go to 120, 130, 150, well, roll your cover call, but do it only 2 weeks before expiration. Otherwise, my opinion, take the profits and move on to the next trade. In the second scenario, if the stock goes sideways, right? Maybe rises a little, moves sideways, or moves a little bit lower here. This is your best case scenario. You want to hold your position either until expiration or roll it at 21 days to expiration. We've back tested both. It really depends on kind of how actively you trade. Some investors like that 21-day rule. The only benefit to the 21-day rule is that there's no risk of early assignment. So that's the only thing that you have to be concerned about, is sometimes if you don't want the stock to be called away, if you want to continue selling cover calls, I do find that the 21-day rule is there so that you avoid early assignment. Otherwise, for some investors where you don't care about early assignment, you don't want to have to actively manage this, holding the position to expiration also works. The two strategies as far as performance goes is very, very similar. So those two, in my opinion, are equal. It just depends on whether you want to actively manage it or not. And lastly, if the stock drops after you sell a cover call, then you simply this is the only scenario where you want to roll your calls down and you want to do it early. And the rule of thumb here as to when you want to roll a cover call early is if you're able to buy it back at 20% of the original premium. So if you sell a cover call for $1 and you're able to buy it back now for just 20 cents, that's your rule of thumb of buying back the cover call and selling a brand new cover call. Which cover call do you want to sell? So when we talk about rolling, right, whether you're rolling here or rolling here or rolling here, all three scenarios, all you have to do is at the time of the roll, you go back to your credit spread, or you go back to your covered call report, and you find the new strike price, the new expiration date and the new strike price. That's what you roll to. So that's why when you think about cover calls, you always want to use the same process for selling cover calls, the same strike price every single time. So this cover call report uses the 20 delta and roughly the 45-day expiration. So as you can see, most of these options are 43 days from expiration. That's the closest one to 45 days. And it finds you that 20 delta so that you're finding a strike price that's far away from the current price. About 40%, 4 out of 5 trades that you sell on a cover call using this report will expire worthless in the long run as you do this type of trade. So only 1 out of 5 trades will you expect this, a cover call to be called away. And those are the stocks that for that month has rallied significantly. Those are the ones that you generally want to take profit on anyway. And then now you can take those profits and roll them to the next month for selling a cash secured put, selling a credit spread, doing whatever else you'd like to do with that capital and not let it remain tied up in a specific stock. So with that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to the optimal cover call and why you should consider using this in your portfolio and how to implement it using our cover call report. So with that, what I'll do is I'll open this up for Q&A, but before I do, and there's a Q&A section here at the bottom of your screen. There's a chat window and a Q&A window. Please bring up your Q&A window and I'll try to answer as many questions out of that section as I possibly can. But just a quick reminder, tomorrow morning, we're doing another rapid fire session at 8:30 in the morning. I hope many of you are able to join us. This is where I take your symbols and I research them, the technicals and the fundamentals, and I provide you with my views. It's a great way for everyone to learn. I really enjoy it because I get to see a lot more symbols in a very short amount of time, and you guys get to as well. You get some insights into how I view my charts, how I do fundamental research on each company, and how I gain a directional view off of the symbols that you want me to take a look at. So really looking forward to do that tomorrow morning. That's a members only session at 8:30 a.m. Eastern. I hope to see many of you there. And again, thank you so much for our members for supporting us and allowing us to continue doing this and building out new features for you to help you improve your options trading. If you don't have an account yet, you can sign up for a free trial at OptionsPlay.com. For those of you that are still in a free trial, to become a member is only $100 a month or $750 a year. You can do it by clicking on the link on your screen, which I just posted into the chat window. So with that, let's go over to some of the questions here on the right-hand side. Let's see. I've also been in a scenario where the stock tanked and I couldn't get filled on buying the call back. Therefore, couldn't sell the shares at significant loss. Realized that cover calls are more for low volatility stocks. So when you say that you couldn't buy back the call, I guess the question is what price you want to buy back the call at, because someone will always sell it to you for, you can always buy it back for $0 or maybe 1 penny. Is generally what I have found, but you can also sell the stock and the call in one order. So you should be able to get filled on that. So I will say the next time that happens, I would contact your broker and have them walk you through potentially how to place that trade. So there's a question here. Please explain rolling a position. So just to be clear, rolling a position is this term that a lot of investors kind of don't understand, but rolling is simply just closing an existing position and opening up a brand new one in a single order. So you can actually buy to close a cover call that you own and sell to open a new cover call in a single order. And when you do it in one order, we could just call it a roll. That's it. Talk about rolling the cover call. I have GLD 165 strike price. Now GLD is almost at 170. I tried to roll, but it's charging a $2.15 premium. Yeah. So, but Wing Ho, like it's charging you $2.15 in premium, but you've earned that $2.15 on the GLD stock that you own. So whatever losses that you have on the cover call, you've gained on the stock itself. So pay the premium and roll it to the next month. How do we access the cover call report on OptionsPlay? So this is within your OptionsPlay hub. So on the OptionsPlay tool, you have this link here on the top, education and resources. When you click on that link, that'll take you to the OptionsPlay hub. Within the OptionsPlay hub, there is a cover call and short put report. When you click on this link here to access that cover call and short put report, it'll take you to the cover call report that I was just showing you here before. What kind of stocks are better? The conservative ones, small income, or risky ones with more income? Nick, that's only a question that's suited for you. What do you prefer to invest in? Do you prefer to invest in very risky stocks that have the potential with a lot of upside, or do you prefer to invest in stocks that have low risk but have higher income? That is your own risk tolerance, and I cannot answer that question for you. Would you please put up the last slide again? If you're referring to this slide, sure. On a position OTN, what gave up the time value by closing early? Why not just wait until expiration? Peter, I'm not sure I understand your question. If you don't mind clarifying. For those of you that asked how to access the cover call report, I hope that I just answered that. You click on the education and resources hub link on the top of your OptionsPlay screen. That'll take you to the hub. And then when you're at the hub, you just go to the cover call and short put report. And that will take you to that report that I just showed you. So should we use Optimal as a selection year software to achieve the results we discussed? Yes, Joseph. Can the optimal cover call report be made downloadable from the online website where it's currently available? That is something that I'm currently working on, is trying to make all these reports easier to access and downloadable. Currently in its form, it's not downloadable, but that is something that we are working on. It is one of the features that people have requested. When you say roll, do you mean close the current one and get a new cover call? That's exactly what I mean, Regino. Chuck, can you sort and filter the report? That is something that we, again, are also working on. Also, does the report come out once a day? The report comes out, if I'm not mistaken, twice a day. Yeah, it comes out twice a day. Once at around 10 a.m. in the morning and once at around 3 p.m. in the afternoon. So as you can see, the last update here was about 2 hours ago at 3 p.m. this afternoon. All presentations and all recordings are always available to our members. If covered call goes above the strike price, when do you roll it? How many days before expiration? So Kevin, I think that's exactly what we're talking about here, is you want to roll that 2 weeks from expiration if a stock goes above your strike price. Hi, Tony. For the earnings trades, i.e. this week, they are profitable now. Do the same exit rules apply to earnings trades? Yeah, earnings or no earnings, the rules are all the same. I generate $90 a month from a 30K bond fund in my IRA. I would like to sell that and use for cover calls. Samuel, I mean, cover calls, I wouldn't make a direct comparison to a bond portfolio, but because it does have more risk than a bond portfolio, but that risk also comes with potentially higher income levels. It takes time and maybe a couple of days to enter my cover calls. How do you enter yours? Ron, cover calls should not take a couple of days. Cover calls really should take, in my opinion, with a report and with OptionsPlay, it should not take more than a couple of minutes at maximum. Most of my cover calls, I'm able to make a decision within about 30 seconds because the report tells me exactly, what expiration, what strike price, how much yield. And usually, especially these yields these days are pretty high. And I'm able to simply put in that order into my broker. And usually they're executed within a few minutes at maximum, because anything with very liquid, I'm usually placing those orders at the mid price and usually getting a fill. And if I'm not getting filled immediately, I usually move them maybe 1 or 2 cents off the mid price, and I'm getting filled basically immediately off of that. I'll be honest, I rarely have orders that sit there for more than 10, 20 seconds before they're filled. Can you put the technical score on the cover call and short put report? So we are in the process of making these a little bit more robust, bringing them into the platform, and the technical score is a good, I would say, feedback on adding that to the cover call report. So yes, I will take a look into that and try to offer more of that type of information in these reports. If I own the stock, would I be selling a call? Yes, you would be selling a call, to sell to open on a cover call. How do I find delta information from your website? Well, Linda, on every single strike price, there's a delta number next to it. You have the strike price, you have the premium, and then you have the delta. So you can use the strike price dropdown on every strategy to select the right deltas. Should we get right away now? Earning is out. Thanks. If you're talking about Etsy, I do think that Etsy is a good time to get out, but I don't think you're in a rush to get out. It's well below the strike price. I actually think you should wait a few days, collect a little bit more of that theta. But I think it's perfectly suitable to get out of Etsy by tomorrow. Will you try to sell a call spread in case stock moves higher? In case the stock moves higher too much? No. It's so easy to say. I understand why people have this fear of missing out because the stock rallied that unexpectedly. And you're thinking to yourself, if I didn't sell this cover call, I would have been better. What I'm trying to explain to you is that 80% of the time that's not going to happen. And the 20% of the time that does happen, those are good times to take profits, because for a cover call to get called away, when you use these types of settings, that means an unexpected rally, an unexpected sharp rally has materialized and you're able to take profit from it. Think of it that way. I think human beings were wired to always think, why couldn't we have possibly made more money? And the reality is that you're never going to be able to maximize, the capital appreciation of every single stock that you own. But when you sell cover calls, you're actually able to maximize it quite a bit, because it's the unexpected rallies that cover calls take advantage of and allow you to profit from. And you take those unexpected profits and roll them to the next trade. And then the other 80% of the trades where the stock is moving down or moving sideways, you're generating 8, 10, 15% yield on those stocks while those stocks are moving sideways and down. That's how you're going to buffer your portfolio from a lot of downside by using these types of strategies. So I encourage you to think about cover calls in a different light. And that's what I'm trying to teach here, is that you have to think about cover calls in a slightly different way, not as an income generating strategy, but as a way for you to buffer most of your portfolio when the stocks are just moving sideways and down. And then when the stocks unexpectedly shoots up in a month, take profits. Take those profits and run, and then buy the next stock and then wait for these stocks to rally. But whenever they rally and they have these unexpected moves, take profits of those, because sometimes if you don't take profits, the stock goes right back down and you didn't take advantage of that. I mean, how often do you have where a stock rallies, you didn't take profits, and then the stock drops right back to where it was before, and you're back to square one with nothing to show for it? At least in a cover call, you have the opportunity to potentially take profit on those sharp moves. And number two, even if you miss out on those sharp moves and you didn't take profits, you at least have yield to show for it. 7, 10, 15% yield is nothing it sounds like a very little each month, but really adds up in the long run. Ramjeet, I am doing another session on small futures on the 20th. So in about 2 weeks time, we're going to have someone from the small exchange joining me on that call. We're going to be talking about trading interest rates with the small futures. So yes, that is coming up in 2 weeks. Are you basing yields on actual and yearly annualized and rolling position with the 20% rule? No, that makes, I'm what's the 20% rule, Richard? Oh, you're talking about taking profits early? No, it's not based on that rule, but even if you did stick to that rule, the yields wouldn't be that different. Can you do this with leap calls? Yes, you can do this with leap calls, but you have to be more diligent about rolling those calls because leap calls, you never want the stock to be called away, right? At least with this cover call, you want the stock to be called away. On a leap call, you do not want the stock to get called away because if you do, you're now short 100 shares of the stock unless you exercise your leaps, and you don't want to exercise your leaps. So you have to be far more diligent in making sure you roll your cover calls, your calls 2 weeks in advance. Is your team thinking about implementing some sort of change in strategy alert? I opened a put debit spread on BABA when the sentiment was very bearish. It's moved against me quite a bit. When I checked the strategy on options, it changed to slightly bullish. Super G, yes, this is something that we actually have built in to our tools, is to show you that. But here's the thing about Super G, as far as like when you say that I could have cut losses early. As far as debit spreads goes, they're defined risk strategies, right? So you don't necessarily just want to cut losses because the trend has changed. You want to cut losses if you lost 50% of the premium that you've sold because you've already defined your risk, right? When the whole point of a debit spread is you know exactly how much you can risk, and you should be comfortable with that before you get into the trade. But your rules to cut losses should not be based on whether the stock fluctuates higher or lower. It should be based on whether you risk a certain percentage of the trade. So the rule of thumb here is that if you put on a debit spread and you've lost 50% of the premium of the debit spread, that's your threshold to cut your losses and move on. I wouldn't go there and change your strategy or cut losses just because the trend has changed. You only want to do it if you've lost 50% of the premium that you've sold, that you purchased. If it doesn't have a deal with the topic, what are the trades listed in the credit spread trades links? I'm not sure I understand that question, Jay Thomas, if you don't mind clarifying. When you roll the cover call, it has to be the same strike price by the new expiration date? No, not at all. You can pick any strike price, and you should pick whatever strike prices are the cover call report is now telling you. So let's say you have a Zoom, 360 call, and now you're selling the new cover call. You want to roll that down to the 340 calls because that is the new strike price. So you always want to pick new strike prices every single time. You do not want to do it with the same strike price. Do any of the rules change if there's going to be earnings prior to expiration? Generally, no. I will say that some investors with cover calls don't like to avoid selling cover calls during earnings. That is something that is, especially if you expect the stock's gonna make a big move, that's usually not a good time to sell cover calls. So I would say it depends on your views of that particular earnings report, especially if you're pretty strong on that stock or pretty bullish on that stock. Those are the times you expect the stock to make a big move. So if that is the case, you do want to avoid going into earnings. Can you show again where to find deltas on OptionsPlay? Sure. You can click on, for any strategy, when you click on modify, you're going to get the drop-down menu for the strike price. And for the expiration date, and you're going to get the strike price for the drop-down. And on the strike price drop-down, you have three numbers. You have your strike price, you have your premium, and you have delta. So it's on your strike drop-down. If I hold to expiration a 10 delta, approximately 10% chance of exercise, do you have any backtesting data on the adjusted chance of exercise at 21 days? For example, if I write a 15 delta call, do I really have a less than 10% likely chance of exercise? So here's the thing. We're not necessarily, when we say chance of exercise, that's different than chance of expiring in the money. Those are two different things. So we're not saying that that's the chance of exercise. We're saying that's the chance of the stock being in the money at expiration. Those are two different things. If it's really difficult to estimate what are the chance of exercise at 21 days. There's really not a great way to go about doing that, to be perfectly honest. How frequently is the cover call report updated? It's updated twice a day, once in the morning, once in the afternoon. How important is IV on choosing the stock? I would say the IV is completely negligible in terms of picking the stock. IV is simply just a factor of how volatile it is. So you should just have a general sense for whether you like to own stocks that are very volatile, where you like to take on a lot of risk with a lot of potential reward, or are you the type of investor where you're more conservative, you don't like to take on a lot of risk. But IV is not, IV is just a factor of that. IV will change over time. You should be more aware of just generally how volatile a stock is. James, yes, we are developing tools to help you manage your positions. We're actually building a Plaid integration so that we can pull in your portfolio from your brokerage platform into our platform, so that we can start showing you, how we can build automated alerts to help you manage your portfolio. We are also in the process of working on an app for the App Store as well. If you don't want to have a stock assigned, but your stock unexpectedly shoots way above your strike price early into the call's expiry, 2+ weeks, is it better just pay the premium and roll out, or wait to see if the stock price falls? So Eric, it's better to wait to see. You should only roll a cover call 2 weeks from expiration. Again, because many times you have a big move. So let's say when the stock was trading at $83 here, right? Let's say when the stock was trading around $83, right around here, you sold that $95 strike thinking to yourself, this stock cannot possibly get above 95 in the next, month and a half. But some news comes out and the stock rallies significantly. Do you want to roll your calls early? No, because first of all, after big moves, there tends to be always a bit of a follow through here, and it comes back to potentially retest that support. So that's why you always want to wait till the 2 weeks. You never want to lock in a loss like this and then sell maybe a higher cover call and only to have the stock drop. That's not what you want. But what you want to do is, the reason that also you want to wait till 2 weeks is because, you want to collect the premium, right? Time premium needs time. So you need for that time to go by in order to collect the premium that you are meant to collect on that cover call. So that's why you should never roll a cover call early if it goes higher. All characteristics being approximately the same on two stocks, which IV rank higher or lower would be a better choice? If everything is the same, then certainly the higher IV rank would be better. What criteria are used to generate the cover call report? It's just all stocks in the S&P 500 and all liquid ETFs. What is your annualized calculation? It's just taking the raw return and annualizing it over the year. I have 500 shares of IBM. I usually use a 5% gain as a strike price. In this case, a 155 strike, 30 to 45 days out, which I think is a good target. Currently, the June 18 calls are 119, 126 with the 20 delta. Would you say a 5% increase is a good rule of thumb, or does volatility kill that theory? So 5%, if the stock's volatility never changes, I would say 5% works. But stock volatility does not stay constant, which is why we do not like using a 5% rule. A 5% rule is going to change from month to month. A delta does not change month to month. A 20 delta will always have a 20% chance of expiring worthless. A 5% rule, some months will be maybe 2%. I mean, some months maybe a 20%, other months maybe a 30%, other months maybe a 10%. You're going to get inconsistent results when you use 5% rule. Use delta to select your strike prices. Buying to close and out of the money before expiration. Buying to close and out of the money before expiration. One gives up the time value of money. I thought I understand you suggest buying the close before expiration. Peter, I'm not sure I understand what you mean. Because if you're buying to close before expiry, you're going to sell another cover call. So yes, you lose out on that time premium, but you're gaining it somewhere else. So you're not really losing out on it, in my opinion. If you don't see a stock on the list, that means it's not in the S&P 500. Just use the OptionsPlay tool, right? So if you BCRX, I'm not sure what stock this is, BioCryst Pharmaceuticals. And then you can use the OptionsPlay tool to do this. So June 18th, $19 call option collects about 9.8% yield on a stock that pays 0 dividends. Can you please help me find Delta? Yeah, I just showed everyone here, modify. And then if you use the strike dropdown, the Delta is next to the strike price. When a stock is trading sideways, what is the benefit of rolling a cover call as opposed to letting it expire? The benefit is so that you don't have early assignment risk. So that's really the only benefit. What about buy rights? A cover call is a buy right. A buy right is basically buying 100 shares and selling that cover call. Hi, Tony. Just did my first trade ever, a cash secured put on Peloton, a 93 strike. Question. Do you think this drop is temporary? And if assigned, where would you put your cover call strike price? Thanks. Steve, I think that's a question for our rapid fire session tomorrow morning. I'll talk about Peloton. It is a stock that I've been looking at. So I will give you my thoughts tomorrow morning during the members only session. I hope that you'll be able to join us. How do you feel about using a buy right strategy? Personally, I'm not a huge fan of a buy right strategy. I usually buy my stocks because I want to buy them, and then I usually decide at a certain time selling cover calls. I'll be honest, I usually don't do those two trades in one order. I usually do the orders separately. I buy the stock and I sell the cover calls separately. But many times I'll do them in back to back, but I will do them in two separate orders, not as one order. Why roll the cover call with 2 weeks before expiration instead of the day before expiration? It's because of early assignment risk. If you wait all the way to the day before expiration, especially in the money options that have a dividend paying, you're almost guaranteed to have early assignment. You're going to lose your shares. So that's why you don't want to wait until 1 day before expiration. Oh, and one thing I want to point out here, there were a lot of people saying earlier on that they don't sell cover calls because of tax concerns. They're concerned that they're going to have to pay they're going to pay capital gains on their tax, on their stock. The one thing that I do want to point out here, let's say, I don't know, what's a good stock to use? Let's just use Apple. Let's say you've owned Apple stock, you've owned it for a long time. Maybe you have it at $60, $70, and you're concerned that if you sell the 140 cover call, you're obligated to sell your stock at 140. That generates a tax bill. The one thing that you have to remember is that tax lots is not based on a first in, first out. Meaning, if you own the stock from $50 and you sell the stock at 140, if you buy the stock back on Monday at 140, you can technically deliver the $140 shares that you purchased on Monday from a tax lot basis. You do not have to deliver the $50 cost basis stock from a cost basis perspective. So keep that in mind. Especially if it's a stock that you own and you want to continue to own, even if it gets called away, it does not have to generate a tax bill for your portfolio, because again, trading or from a tax perspective is not a first in, first out rule. You can do first and last out. So, that's the thing that's the one thing that you can, last and last out. So you don't necessarily have to deliver your low cost basis stock from a tax perspective. What does the technical score entail? The technical score is a relative strength ranking. It ranks each stock against every other stock in the markets. So the strongest stocks are the ones that are ranked 10. These are the stocks that are outperforming the broader markets. The ones ranked 1 are the ones underperforming the markets. The ones ranked 5 are the ones that are performing on par with the market. So you have this scale to give you a sense whether the stock is outperforming or underperforming the broader markets. If the stock goes above your strike price 20 days in, will they get taken away from me? Not until expiration will the stock get called away from you. So if you still have 20 days to expiration, the stock will very unlikely get called away from you that early. Etsy was a great trade. Thank you so much. Is it too late to get into Morgan Stanley? I do think today's move makes it a little bit late to get into Morgan Stanley, in my opinion. If the stock continues to fall below your cost basis, what delta do you use so you're not called out below your cost basis? If the stock continues to fall below your cost basis, what delta do you use so you're not called out? So, I mean, Michael, that's a tough call, right? Meaning, are you willing to sell a stock at a loss? If you're not willing to sell your stock at a loss, it's difficult. I would say only use the 10 deltas, only if that's above your cost basis. But I understand if you don't want to sell a cover call on something that you have a negative cost basis on, then don't sell calls on those stocks. Do you ever write in the money cover calls? Never, ever write in the money cover calls. There's no time decay. What's the point of selling an in the money cover call with no time decay? Poor man's cover call. Do you recommend them? Yes. If you're buying leaps, you can sell cover calls against them. The one caveat I will have to again say is that if you're selling cover calls on leaps, you have to be very careful and very diligent about rolling them. If you let them go to expiration and the stock gets effectively called away, you are now short 100 shares of the stock against your long leap. It's not the end of the world, but not a great position to be in. Do you sell cover calls around earnings of a stock? I do, but sometimes, especially on stocks that I'm more neutral on or maybe even bearish on, I'll sell a cover call on, but I generally won't sell cover calls on a stock that I think will beat earnings and do fairly well. I had lost a few positions to cover calls when the market rallied back up since last year, so I've been a bit timid. Maybe I'll start trying again. I guess I've been suffering from seller's remorse. Christine, that's pretty common, I would say. But usually, whenever when you have that seller's remorse, is it just me or do others have positions in their portfolio where they can't bring themselves to sell conservative calls for fear of losing out? Well, Christine, I mean, I would say that when I asked at the beginning of the session, that was a concern that a lot of people have, but you move on. I mean, these positions are like my children. Well, I will say that I don't know. I don't believe in being emotionally attached to positions. They're just stocks. There's thousands of stocks out there that you can pick from. Don't get too hung up on one over the other. If you take profits on one, well, buy another stock. Okay, that covers all the time, all the questions that I have time for here today. I just want to thank again everyone for taking the time out here this afternoon. I really hope that you find this useful and giving you a better understanding of cover calls and a different way to think about it. Because again, I do think that if you just think about them as an income generating strategy that could potentially rob you of upside gains in your stock, you're thinking about this in the wrong way, and likely you're choosing your strike prices in the wrong way. So if you pick your strike prices based on just a probability of expiring worthless at a low probability, and you're not too focused on the income, that's when it's going to pay dividends for you in the long run. So try it out, especially for those of you that are new to this or maybe a little gun shy because you've had some stocks called away. Take a different approach and see if it's better suited for you. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys tomorrow morning during our rapid fire session. Again, I hope many of you have already submitted your symbols. If you have not, you still have a few hours to do so before we tally them up for my research tomorrow morning. I do my research at about 7 a.m. in the morning, where I take a look at all the stocks and I go through all the charts and go through the fundamentals and share them with you at 8:30 in the morning. So with that, have a great evening, and I'll see you guys tomorrow morning.